Welcome back to Switzer and Australia's Business Channel. My next guest has long warned about the worries of a housing bubble, and he suggested that it could undermine the balance sheets of our precious banks. To find out why and to raise some arguments against his forebodings, Christopher Joye from the AFR and Yellow Brick Road joins us in the studio, and expect some sparks, but reasonable sparks. How are you, mate?
Yeah, good. And just a quick call out to a mate of mine, KK from Tassie, who's been a great inspiration.
Okay, great. Does he watch the show?
I think so, yeah.
Or he's an intelligent guy? Go for it, KK. All right, mate. You've been writing a lot of stories in the AFR, and some people have come to me and said, yeah, do you think he's right? Do you think he's right? So that's why I want you on the show.
Sure.
So, first thing, do you think there is a housing bubble?
Probably not right now, but I think we're priced for perfection.
Chris, that's
we're
great.
priced for perfection, and I think by June next year we could see one.
All right.
I can talk you through those numbers.
That's a possibility. It's a possibility.
Yeah.
All right. Why do you think the Reserve Bank, APRA, all the risk guys, all the big banks, how come they're missing it and you're saying, now I know you're smart, that's why you're on the show, but why do you think you're right?
Well, I speak to all those guys and I think they're all worried. But I think it's also useful, I mean, there's a lot of hysteria around the housing market. It's useful to focus on some facts. So here are the numbers. I checked the latest RP data index information through to 4 October, and that's the RBA's publicly preferred index. Okay? Yep. So basically today, mate, Australian house prices across the nation, the 5 capital cities, are up 8.5%.
Is that over 10 months?
Yeah, for the first 10 months.
Yeah, because 7% over 9 months.
That's right, 8.5% for the 5 capital cities, 13% for Sydney over the first 10 months of the year. So annualised house prices are rising at about 10% per annum, about 16% per annum in Sydney. Now today, across those 5 capital cities, prices are 16% above where they were right before the crisis in 2008. They're 2% to 3% above their all-time peaks. So house prices are higher than they've ever been before.
But you haven't adjusted them for inflation, have you, Chris?
No, I haven't adjusted them for inflation. So this is a really important point, and this is the second part of what I was going to say.
Okay.
So the key thing is, how are house prices travelling relative to incomes, relative to purchasing power? And it's fascinating. So the RBA's preferred valuation benchmark, Peter, is to divide house prices by incomes per household. What we know is that house price to income ratio in 1990 was 2.5 times. By 2000, it was 2.8 times. It peaked at just above 4.2 times.
When?
In mid-2010.
Okay.
Got as low as 3.7 times last year. By the end of next month, it'll be back at 4.1 times. If the market continues travelling at its current pace, by June next year, Australian housing relative to household incomes will be more expensive than it ever has been before in history. That's my concern.
Yeah, but given the fact you've got this relationship between income and debt, won't that mean that sometime between now and maybe June, the risk guys at banks will say, it's like, to quote the soup Nazi from Seinfeld, no more loans for you.
Yeah,
so
there is a risk
that's why I think, well, we're gambling on whether the risk guys and the CEOs of these banks are stupid enough to let this get out of hand.
So the issue for the banks is they've been punching out these mid-teen returns on equity, and they've been producing profits that are similar to what they've had for the last 10 to 20 years. But the rub is, the mystery is, that credit growth in Australia
is low.
Is running at about 3% per annum.
What was it before the GFC?
Before the 20, GFC, it averaged, during the 1990s and the 2000s, it averaged at between 10 and 14% per annum.
Huge competitive.
So how are they doing it?
Cost cutting.
The
efficiency.
This is true. We can talk about it later. But the concern is that borrowing rates today are at their lowest levels in recorded history, 50, 60 years. To get borrowing rates, mortgage rates, back to normal levels, the average level, they've got to increase by 50%, mate.
All right, let's just talk about that now, because if we look at what the Reserve Bank watches, they watch the variable rate. They don't really watch the cash rate, do they?
No, that's right.
So the variable rate now,
the discounted variable rate bank,
the major banks is around 5.95%.
That's the headline. They actually look at the discounted rate, which is, I think, around 5.1%, according to the RBA.
Better customers get that. All right, so we average that. So if it's this is, I argue 5.25%, because
whatever.
So now the long-term average is 7.2%, right? So if we go, say, 5.1, that's about a 2% difference.
Or a 50% increase.
2% difference. a little bit less than 50%, because we're at 2.5.
So if you use the RBA's numbers, it's at 5.1, and the RBA's numbers since 93, the average discount rate has been about 7.6.
And wouldn't we put 2 on the 5.1?
Yeah.
That's not 50%, is it?
It's not exactly 50%, but it's a big increase. Sure.
All right. Another little point I've got to say to you is...
So we're talking about a very big increase in mortgage rates. Here's the rub. You've got whatever kind of benchmarks you're using, you're looking at a 30 to 50% increase in current mortgage rates.
But based on history, isn't it?
Yeah, based on the average since 93, right?
That's right.
You get a big increase in mortgage rates just to get back to normal. And then if the RBA gets tight on policy, you could see mortgage rates back at 8 or 9%, where they were in 2008.
All right. Now, when I was talking to you...
So that's a bit of a worry.
So when I was talking to your colleague and editor-in-chief, Michael Stutchby, last night, I said to him, we're tossing this around. And I said, well, maybe, Michael, maybe this time we really can say, this time it's different. Now, I know the irony of saying something like that, but when we go back to the time when the long-term normal
rate was 7.2%,
what was the average inflation rate? I would say it was closer to 4 than 2, wouldn't you? Because you got a memory.
I can tell you the number. Yeah. So since 1993, the average mortgage rate's been around 7.5%. The average inflation rate's been about 2.9. Yeah, since 93.
So we're down around 2.2, 2.3 now.
Yeah, there's not a huge amount of difference.
Well, 0.6 over 0.2, you do the percentages.
Sure.
That's huge.
Yeah. But the concern, of course, is if tapering ends in the US, Aussie dollar comes down to mid-80 US cents. We could get tradables inflation increasing. We know domestic inflation in Australia is running about 4%. We haven't seen any given that. So I don't think inflation is low, mate.
Okay. Well, I think it's historically low.
That's true.
Yeah, it's not
low.
But
the inflation risks, I think, are skewed to the upside.
Okay. But you also know that the Aussie dollar is pretty high.
Mate, forget inflation. I'm talking about incomes. That's what counts wages. House prices are running at more than 3 times wages.
You're changing the argument now because you were losing that one.
House prices to incomes are B's appendage away from their all-time highs. So, again, at the current rate of growth, by June next year, the Aussie housing market will be more expensive relative to incomes than it's ever been.
But that will be based on the supposition that income won't grow quickly, and I agree with that. I can't see that. It's also based on the lenders at banks act irresponsibly.
No, they just do what they're currently doing.
Well, wouldn't they also be aware of this? Because, as you say, you talk to them, they read you everything. They can't live a Saturday without reading you, Christopher, you know. They'll be mindful. So
I think there's a tension here. I think the banks are Gail Kelly's come out and she says she wants to foster more credit growth. The banks are desperately keen to lubricate mortgage volumes. So I don't think the banks are going to be trying to in any way decelerate credit growth. So I think, if anything, the banks are going to be a force for higher rates of credit growth, higher house price growth, which will improve their collateral values. And they really want to capitalise on this 60-year unique window in history where we have the discounted variable mortgage rate at 5.1%, lower than it's ever been in our lifetimes.
But Christopher, could it be possible that after this...
I'm not saying, listen, the market's going to crater, they're going to have 40% falls in house prices. What I'm saying is we've got to be wary and mindful of these risks.
And I think one of the reasons why I care more than anything is that a lot of people watch this show are invested in the banks, and this has implications for the banks. And you're writing about the banks, is it tomorrow or the weekend?
No, tomorrow, I think, possibly on the front page.
All right. Yeah. So possibly the front page after this interview, it should be.
Stutch will make that call,
Yeah, all right. Now, so what are you going to say tomorrow that will scare the pants off us?
What is slightly scary is this mystery of credit growth has been running at 10 to 14% during the 1990s and 2000s. It's currently running at just 3%. So how do the banks produce profits that are very similar to what they've done for the last 20 years? The answer is that they have been consistently cutting their insurance or provisioning against bad debts. In the last half of the financial year that they reported, bank profits would have been negative, as in profit growth rates, earnings per share growth would have fallen, but for the banks cutting provisioning against bad debts.
But bank you held up there. But there was a time there where the provision was actually quite big, and they were wrong. That the actual provisioning was too much, wasn't it? Was that period as well?
And that's a legitimate debate. All I'm saying is that bank profits are being driven by really two things. Certainly in the last half, cutting insurance against loan losses and bad future outcomes at a time when borrowing rates are at 60-year lows and house prices are running at double-digit rates. There are also some tax effects, and we also know that if we stretch time back a little bit further, so we look over the last 12 months, we find that, again, the biggest driver of bank profits have been reductions in provisioning. The other key driver of shareholder returns has been an increase in payout ratios, dividend payout ratios. So basically what you're doing is you're seeing less insurance against bad times, and you're seeing the banks returning capital, so therefore increasing leverage by paying out dividends and reducing the capital that they would otherwise have. And that's a bit of a concern when you think that, just let me get this fact across the table, that if you look at the bank's capital vis-a-vis their home loans, their assets, they're leveraged about 80 times in true terms.
And where were they, say, in 2006?
They would have been at similar levels.
Similar levels.
Yeah.
Okay.
So the point is that leverage hasn't really radically reduced.
But the interesting thing, people I hope be saying, I'll go represent the people who can't get in this table and say, Joy, you're wrong. During that period of the GFC, we were rated as some of the best banks, top 10 banks in the world.
Yep, the banks basically flew me around the world, and I presented to all their clients, the institutional investors, to explain why the housing market would not crash and why the banks
were... And why Jeremy Grantham was wrong. And you were on the other side of this.
I know.
You were a good guy then.
Yeah, that's right. And why the banks were a good bet.
You weren't writing for the Fin Review then.
But let me just say this. Here's the issue. Right. Bank share prices are assuming that these double-digit returns on equity will persist indefinitely. And my concern is that they're maintaining them right now through these artificial one-offs.
But with the credit growth, Chris, when the credit growth picks up, won't their profitability improve?
So here's the point. If credit growth tracks incomes through the cycle, which is what it's doing right now, so if we don't get a big pickup in credit growth, perhaps because the bankers are looking at the housing market and saying, it looks a little bit frothy, right? If we don't get that pickup in credit growth, and we can't reduce loan loss provisioning any further, and we can't increase dividend payout ratios any further, and we can't cut costs any more than we have, the risk is you get a new normalisation in bank profitability, and you get returns on equity that are much lower, and that could potentially be bad for the big banks, not so bad for the regional banks.
But what they would do is chop the dividend, which of course we all would hate. But they could chop a dividend, and we could go down to a 4% rather than a 6 or 7%. Grossed up still at 6.
Well, if their bank share prices fall significantly, we might see high dividend yields. So it's just a question, and it's an issue to consider.
Yeah, interesting. Okay, but I'd love to get all the CEOs together and after you publish your article tomorrow and see what they say. But still,
absolutely.
All right. Now, apart from picking on banks and self-managed super fund, people who want to buy property, these are all the people you've been picking on lately. You also pick on the poor old Chinese telecom company, Huawei. Now, what's the story there?
Yeah, so Huawei is the biggest telco in the world. They've been banned from the NBN. I published a big article on the weekend just explaining what the spooks, the intelligence agencies had told government as to their sort of nightmare scenarios around the company. Listen, the company is a very good company. It's a very successful company.
Is it operating freely in other countries of the world?
In some, not in the US. It's more or less been banned from the US market. It's working relatively effectively in the UK. The issue is it's got about $30 billion of financing from Chinese state banks. The issue is the intelligence agencies say that, and I don't know whether this is right, but they say that they've put malicious backdoors in their routers to allow the Chinese state...
Routers or routers?
Routers, routers,
I prefer routers on a family program.
Okay, so for the family folks, the routers or the routers. So they've had these backdoors, which is akin to spyware that would allow Chinese security services to pick up valuable information. And then finally, there are very close ties to the Chinese state. So the chairman of Huawei used to work for the Foreign Espionage Service, chairwoman, and the founder of Huawei was basically a guy that was a deputy director in the PLA, the Chinese army. So there are question marks. The judgment call was the AG came out and said they're not going to participate. Hockey said the same thing. The PM reiterated it. A bit of a tension there with Malcolm Turnbull.
But Malcolm's comfortable with the Chinese?
I think he has a slightly, I don't want to misrepresent him in any way, shape or form, but I think his view is that maybe there's a part of the NBN that they could participate in where you minimise national security risks. I'm sympathetic to that argument, but at the end of the day, we've backed the Americans. We've fallen into line with the alliance view of the world. But it was a fascinating story. I mean, I spoke to all the intelligence agencies, and these are, wonderful men and women who get no sort of public...
You're an amazing guy.
Thanks, mate.
Now, but here's the last question.
The curveball.
Yeah. Your mum, your dad, your uncle says, I've got bank stocks, Christopher, I'm reading you here, do I sell?
I'm a big believer that the regional banks will, I think the competitive playing field in the future will be levelled, in part through the hockey review. And I think that the advantages the majors have had vis-a-vis all the competitors, which are complex advantages, but massive advantages.
But if you bought CBA at 35,
yeah,
45...
I'd be switching into Bendigo and Adelaide, Bank of Queensland and Suncorp.
Yeah. But would you be dumping stocks or just buying less now?
Mate, I can't give you sort of advice on individual stock valuations.
I've got to
say, I like the bank bonds.
Yeah, okay.
So I like being higher up the capital structure. I'm not so comfortable with the bank equity. I think there's a fair bit of downside risk.
All right, mate. Fantastic. Thanks for joining us. There wasn't enough sparks, but still, it was a good debate. After the break, we'll get another opinion on the housing bubble and see whether our next guest shares the same views as the wonderful Christopher Joye.